Hey, what's going on YouTube? Welcome back to another video. Today I'm going to be breaking down 3 simple steps to analyze any multifamily deal across the entire country. And make sure you stick around till the end so that way you have tangible steps to get off this YouTube video and go out and take action and start looking at multifamily deals. So starting out, looking at it from a high level, here are the 3 steps just so you can see them. Step number 1, we're going to be looking at the current condition and the income. We'll walk through what this means. Step number 2 is determining the Capex required or the proposed business plan, like how in the world do you increase the value of the building. And then step number 3 is determining the future value and potential profit splits between you and the investors that you're likely raising money from on this deal. And I'm telling you, it doesn't matter the size of the property, it doesn't matter the location. These are the exact same 3 steps that we have used to acquire over $65 million and over 400 units in the last 36 months. So I'm telling you, this works. So step number 1, you want to solve for the current condition and the current NOI. This stands for net operating income, and I'll go through what both of these actually mean. And so what I mean when I say the condition of the multifamily property is what are the unit conditions, when's the last time it was renovated, how old are the roofs, how old are the HVACs, like what condition is the property in, what year was it built, what type of construction is it, and really understanding all the things that could be wrong with the property that's going to determine what you have to do to it to fix it. So I want to know the condition of the property, and then most importantly, I want to know what the current net operating income is. And so all you do to determine what the current NOI is you take all of the income from the rent roll and you subtract all of the new expenses like new property management, taxes, and insurance, and then what's left over is your takeover net operating income. And the current takeover net operating income is going to be very important when it comes to financing the asset and the type of loan that I can even get on it and how much of a loan amount the property can support. Because again, in multifamily real estate, the type of debt that you can get is based 95% on the asset and the current income and not the individual borrower. And so to simplify this step number 1 for all my single family people that are doing like flips, this is a very simple way of asking how much is it and what's wrong with it. All right, now moving into step number 2, which is understanding the Capex or the business plan that's required to add the value to the property to make all the money that you want to make. So now I understand what condition the property is in today, and I know how much income there is. Now I'm trying to go into the future, and I'm trying to determine, 1, how much Capex is actually needed, like how much do I need to allocate to fix the roof, to fix the units, to fix the dog park, and all the fun stuff. And then number 2, based on the renovations and the improvements that we're making to the property, how much upside is at the property, meaning how much can I grow the NOI. In the multifamily world, you hear everybody talking about increasing the rents, which is just increasing the income of the property. The expenses stay the same, and what actually changes is your net operating income. And that's why the 3rd bullet point you see right here is what is the pro forma or future. It's just pro forma is a fancy way of saying future NOI. So again, just so you can see it, step number 1, I'm figuring out what is the current condition of the building, and then what's the takeover or current existing net operating income. What am I buying as an investor? And then based on the improvements that I'm making through Capex, how much upside can I anticipate? And ultimately, where can I take the NOI to? Because how you determine the future value of the building or the after repair value for all my flippers is you take this pro forma NOI and you divide it by a cap rate, and that's what determines your exit value. And so again, simplifying it, step number 1 was how much is it, what's wrong with it. Step number 2 is what is it worth after the renovations. It's very easy to make a judgment, is there enough profit on the property? And now moving into the last step, which is where I see most investors getting stuck at because it's just new and they've never done it before, which is determining the future value and understanding the profit splits to the investors that you raise the money from. Again, kind of tying it back to what I just said in step number 2, we determined what the future net operating income is, and to determine what the max value is after you're done doing your magical business plan, we need to solve for what is max value. You take that future NOI, divide it by a cap rate, and that is the value of the building in the future. Now, beyond that, this is where everybody gets stuck. How do you know if it's a good deal? So how you make decisions as a sponsor or somebody that's the GP and going out and doing the deals is I have targeted returns for the investors that we're raising money from. These are considered limited partners or LPs. And so if you invest 100 grand with me and I can send you back 200 grand over a 5-year hold period, that is a good deal. Between the cash flow and the appreciation, if we can hit a 15 to 20% annualized return, we are happy. That's what I consider a great deal for the limited partners or passive investors that do nothing other than just write a check and collect their cash flow every month, plus the upside on a sale. Now, where you need to make the decision is if there's enough money to make the LPs happy, is there enough money for the GPs that are involved in the deal to be happy as well? Generally, you can reach a conclusion on if you want to go after a property based on is there enough money for the investors that you need to buy the deal? And then secondly, is there enough money for you for trading time, energy, and effort, and probably a lot of headache to go out and make a couple $100,000 on a transaction, or maybe even millions if you're doing big enough deals. If there is enough money for me for doing the deal, like I won't do a deal unless I can personally pick up 250 to 500 grand on it. And gradually, as you do bigger deals, that threshold does go up. So if I can make 250 to 500 and the investors can hit 15 to 20% annualized returns, then that in my eyes is a great deal. And we're going to submit an offer at a purchase price that achieves both of these things. So again, to recap, step number 1, how much is it? Step number 2, what's it worth after everything is said and done to it? And then step number 3, is there enough money to go around for both the investors and you for doing the deal? So hopefully you have a good understanding of the process that we use to analyze the deals. Now, before we jump into me actually showing you a real life example on a deal that we're buying right this second, if you're finding any value throughout these videos and you want to take it a step further, then I invite you to check out our community called the Deal Room, where you can join for just 97 bucks a month, and we give you a completely free 30-day trial to actually see everything on the inside. If you want to join weekly live Zoom calls where we're looking at deals every single week across the country and meet hundreds of other investors, then make sure you click the link down below in the description, get signed up for a 30-day trial, and I can't wait to see you on our next weekly live Zoom call. So now let's jump into the actual example so we can take definition and theory and actually put it into a real deal. Jumping into our current acquisition, it is a 68-unit multifamily apartment complex in Ocala, Florida. It's called Village Square Apartments. We're under contract for it for $9.9 million. Now, the important stuff that you need to know, we're going to go through it whenever we're going through the sale and the future profits, is that we're buying it for almost $10 million. We're getting a $7 million loan on it, and we're raising $4.5 million of equity to close the deal and do all of the renovations at the property. Those are the numbers that you're going to need to hang on to. Now, looking at this deal in the exact same 3 steps that we just went over, step number 1 is figuring out the current condition and the current net operating income. So the condition of the building, it's built in 74, so it is an older product. However, it is a concrete and block building. And some of the big items like mechanicals, electrical, plumbing, and the roofs have all been updated or replaced recently. Those are the big things that you want to pay attention to when buying older product. Now, besides this, this is the classic value add deal that we're looking at. A lot of the interiors have already been touched, but we're going to go in and make them a little bit nicer. So we have to do a light value add play on the inside. This is a big exterior / amenity project for us. I'll make sure that we throw up a couple of pictures just so you can see it. We're going to make sure that the pool is really well done. We're redoing the clubhouse, doing the leasing office, and we're trying to upgrade this asset from a C+ into a B- asset in a B location. So that's the current condition. It helps us understand what we can do to it to improve it or improve the value. And then most importantly, the takeover NOI, this is how you actually solve for it. So there's $1.1 million of current existing income being collected from rents from the residents at the property. And then there's roughly about $400,000 of new operating expenses like management fees, payroll, insurance, and property taxes that we have to pay to run the property. That means there's a net operating income of about 700 grand left over. And quick pop quiz for all the people that are paying attention to our YouTube videos. If we're buying the building for almost $10 million and we have an NOI of 700 grand, what is our going in cap rate? Let me know down below in the comments and maybe we'll send you some deal room swag. So step number one, we've identified the condition is a lighter value add deal on the inside and more of a heavier value add on the outside of the property. That's where a lot of our attention is going to be. And our current takeover NOI is about 700 grand. Now moving into the future, this is what really matters. This is our Capex. This is where all of the money is made. So we are raising $1.3 million in total from the investors in this property to actually do the renovations that we're talking about. So we have 800 grand allocated for the interior of the unit. By no means are we planning on spending it, but it's better to have it and not need it and just redistribute it later on a sale versus needing it and not having it. So we have 800 here, we have 400 for the exterior and 100 sitting in reserves just so we don't run out of money at this project. And so by injecting over $1 million of renovations into the property, we're anticipating a $300 increase on the rents. You might not think that $300 is a lot, but in this business, it can make you a very wealthy person if you can identify a lease that you can take from 1,000 to 13 or 13 to 16 or 2,000 to 2,300 bucks. In order to identify what the future NOI is, here's the simplest way to do it. You take your upside, which is $300, and you multiply it by the number of units, and you multiply it by 12 because everything in multifamily is by 12 months. So if you take 300, multiply it by 68, and multiply it by 12 months, you'll get like 244. I just rounded up to 250 of additional income to the property, and all you're doing to achieve this additional income is changing the lease from 1,300 to 1,600. And so the easiest way to figure out what your future NOI is we are going to take our current, this is our existing takeover NOI of 700 grand, and we're going to simply add the $250,000 of additional income because all you're doing is increasing the income, expenses stay the same, and your NOI will grow relatively close to 1-to-1. So we're taking 700, we're adding the additional 250 to the property, which means by the end of year 3, our target NOI is $950,000. This is the number that we're going to show to a bank for a refi or show to another seller who wants to buy our building. And tying all of this together, step number 3, which is determining the future value, looking at it, if you did sell it, how much money would both the investor make and you make for doing the deal? So we're taking our future NOI of $950,000. We're going to divide it by a 6% cap rate to come up with a future value of almost $16 million. We're calling it $15.8 million is our target value after everything is said and done. So we're in for $10 million. We're putting $1.3 million into it to improve it. So we're all in for like 11.3 or 11.5. And we're out of this for almost $16 million, and we think that it will take less than 3 years to accomplish this. And in this specific deal, we're planning to do a cash out refi and just send all of the money back to the investors, and then we stay in the deal through and through until we eventually sell it later on. I want to look at it as a potential sale just to see what the returns would be. So we sell it for almost $16 million. We pay off the $7 million loan that we initially got to acquire the property. We send back $4.5 million of equity. So we send all the money back to the investors, make them whole, and then there's $4.3 million of profit to split between the limited partner and the general partner. And for us, we're doing a 70-30 profit split, meaning 70% of all the profits go to the investor that funded the transaction, and then 30% of the profits come to the general partner for finding the deal, closing it, managing it, executing the business plan, and ultimately generating these returns for the passive investor. And so just so you can see it, 70% of 4.3 is about $3 million of additional profit that the investors get above their 4.5 that they put in. So if you take $3 million of profit and divide it by $4.5 million of initial investment to get into it, it is a 70% return on investment over a 3-year period. Plus, we're not even including the cash flow that they're being paid on a monthly basis. And then again, for us, the general partners, for doing everything and making it very passive, you can kind of see why people want to do this business. Is 30% of $4 million is $1.3 million of a profit paid to the general partner for doing everything. In my eyes, if the investors are getting 15 to 20% annualized returns and we get to make over $1 million, then that is a fantastic deal, and that's why we are buying it. All right, so tying all this together, again, the 3 steps, we're looking at current condition, current NOI, we have the current condition, current NOI. Then we look at the Capex or proposed business plan. What is it worth after everything is said and done? We determine that there's $250,000 of additional net operating income to generate at the property, and then rolling into the future value or the profits that everybody can make. If there's enough profits at the property after everything is said and done between both the investor and you for doing the deal, that is a great deal. You should try to move that deal forward and submit an offer based on a price that works for you. And there's nothing stopping you from going to Crexy.com or LoopNet and finding a deal that you can practice this exact same process on right this second. So I encourage you to do that. And as always, if you found any value throughout today's video, all we ask is make sure you like, drop a comment on what you found most valuable or what you want to see the next time. And most importantly, make sure you hit the subscribe button so you can stay tuned for all of the content that we're bringing out. Ladies and gentlemen, I will see you on the next one.